It's been critical for the Federal Reserve to pump the brakes a little bit, but not send its passengers through the front windshield. And that's, I think, a little bit what we all feel like right now. It's hard to believe that we're entering our fourth year of broadcasting, but we just, number one, would like to thank you, our listeners, and number two, some of the great guests that we've had on over the past years. Today we have our standard fixture, Chris Zaccarelli, who will be talking to us about his views on the markets and maybe helping us make some sense of what's going on in our world. Secondly, we've got a special guest, Traylor McNeil, who's the Director of Development for Hang Tough. I did want to make a special note that I'm flying solo today because my wingman, Eddie Hatch, is celebrating the birth of his third child, Isabella, who was born on the 5th of July. We just send congratulations out to the Hatch family. I know that they're adjusting and trying to cope with the new world order, but we definitely miss Eddie today. We have as our standard fare, Chris Zaccarelli, hailing from North Carolina. Chris, welcome.
Thanks, Dan. Great to be back.
And I understand you've been doing a little global research on the markets and have recently been overseas.
That's true. Yeah, we had a nice trip. It was over in France with my wife. We were celebrating a wedding anniversary, and so we had a good chance to drink some wine, eat some food. I won't say that we investigated any companies specifically, but we were definitely enjoying the being out of the country and keep an eye on how things were faring over there. Despite what everybody's talking about, slowdown worldwide, it seemed pretty crowded in the airports and was pretty busy around the country. I didn't see any slowdown in the economy, even in France, despite what you might hear on TV.
Well, I think you could maybe spin that into consumer discretionary research.
That's a great point.
Anyway, obviously a lot going on in the markets. This week is specifically a week where we've seen some numbers come out, which has caused, I won't say increased volatility because we've had volatility over the last few weeks, but maybe comment on consumer price index and some of the numbers, the producer price index that came out today, and what sort of bearing that has on investments and just overall thoughts about the economy.
Yeah, absolutely. Well, this week we already had the consumer price index and the producer price index. So those are two different ways of measuring inflation in the economy in terms of how prices are moving with both consumers and producers. And unfortunately, they both continue to tick higher. Not only are they moving up in terms of magnitude, but the increases continue. There's been a lot of talk about potentially peak inflation, where despite the fact that prices have gone up a lot, this pace at which they're going up was going to slow down. And unfortunately, we still haven't seen that. So inflation remains a pretty big problem in terms of prices continuing to move higher at a quick pace. And so that has the Federal Reserve's attention. And because the Federal Reserve cares about keeping inflation in check, that's one of the two main reasons they exist. One is full employment, and the other is price stability. So to the extent that they need to keep prices more at that 2 to 3% level in terms of annual increases, they're not succeeding at that job. And so that has them raising interest rates. And so ultimately, all of this talk about raising interest rates are what's causing a lot of the volatility in the markets. As you mentioned, clearly this has been a difficult year. Both stocks and bonds are down at the same time, and we're continuing to have volatility in the markets. We had some earnings this week. This was the first week to kick off earnings reports from companies that are talking about their second quarter earnings that ended the quarter ending on June 30th. And so we've had some consumer staples companies, a large beverage and snacks company, have very good earnings and forecasted out continued strength in terms of their business. But we've also had some large banks report their earnings, and they are seeing some increased stress within the economy. So I think ultimately we'll continue to watch earnings, and earnings have been positive, but unfortunately they haven't been as positive as they've been in previous years. And it's really the forecast, the looking forward, that has more people worried. As I mentioned, some of those more consistent earnings companies are still holding up well, but those companies that are more cyclical, ones that do better in boom times and not as well in downturns, are already showing some signs of weakness, and I think that has investors' attention right now.
So the Fed's next meeting is when?
The Fed's going to be meeting the last week of July, so about 2 weeks from when we're recording this podcast.
Okay, and we would think that, 75 basis points for sure, and maybe even a 1 point raise, or what's the word out there?
I think that's spot on. Typically the Federal Reserve would raise interest rates by 0.25%. They have already shown a willingness to do that at 0.5%, and at the most recent meeting they did 0.75% and indicated that they would do the same thing. So I think they're most likely to raise rates 0.75% at the end of July. If for some reason they don't do 0.75%, they're more likely to do 1% than 0.5%, and that's because of all the inflation that we've been talking about. It's possible that they want to get rates higher even more quickly than they had indicated as recently as a month ago because of the high inflation readings.
If you would comment, there's a school of thought out there that we're getting these economic numbers, which are sort of retrovision of what has happened in the economy. But if you actually look at the products, the goods, and the services in the market now, we're already starting to see some downward pressure on pricing. We're not continuing to see the rapid increases in goods and services, actually, if you're a buyer of those items in the marketplace. And so these reactions to the higher economic indicators as they're coming out are a little bit off the mark. Is there any truth to that maybe we are starting to see some slowdown in inflation due to the actions of the Fed, or are we still in the danger zone, so to speak?
Well, I take that question in two parts. The first is it possible that we've already seen some increases in prices that are starting to come back down? And I would say absolutely that's true. The report that we just saw was for June. It was released in the beginning of July. And so it is backward looking. All of these reports, of course, are looking back in time, not looking forward. And they're not trying to predict anything. They're just recording what they've seen in the past. And so a lot of what we saw in that very high CPI number was gasoline prices and some other things that have already started to come back down. So if you kind of look at what they call that headline number, that big number that makes the news, that's been going higher, and it's very possible that may come back down. They also have what they call a core number, which is a smaller basket of goods and services, not including energy, which is very volatile, and also not including food for the same reason. And so, whereas obviously food and energy are very important, as an economist, people are looking at more of those core prices. And so those continue to go higher as well. So I'd say for the first part of your question, there's definitely parts of inflation that can already be coming down, and it is possible that we will start to see some low numbers going forward, or lower numbers than what we've been seeing so far. As far as the Fed is concerned, what the Fed does when they're raising short-term interest rates, it takes a long time for that to filter through the economy. So, they've really only been raising rates for a few months at this point. And so sometimes it takes 6 months or a year for the full impact of those rate increases or rate decreases to take effect. Typically, financial markets like stock markets and bond markets will reflect the impact of those changes much more quickly. But as far as the real economy, in terms of mortgage rates going higher, having an impact on people buying houses, credit card balances and rates going higher, car loans going higher. Clearly it takes time for people who are borrowing money at these new higher levels to have that impact their behavior before it impacts the behavior of the economy as a whole. So they talk about the Federal Reserve's actions as taking place with a lag. And so I would say regardless of what we're seeing with the inflation numbers, a lot of the Fed's rate increases won't necessarily have an impact on the economy immediately, but clearly it's a moving target as the Fed continues to raise interest rates, that there will be a lag to those future rate increases as well. So it's a little bit more complicated than looking at the Fed raising rates up until the point where inflation is peaked and then they can stop.
Got it. Well, let's turn from maybe the macro economy to more specifically the people that are listening to this, and that's the investors. I've got one client who's recently come to the market to invest, and they've come in with cash. Talk a little bit about what your strategy is if people have new money to invest. And then the second part of the question is, for those investors that are sort of beyond the accumulation phase of investing and they're now in the distribution phase where they may be in retirement, maybe taking money out of the market. If you could sort of cover those two areas and specifically what strategies you're using in this environment, that would be helpful.
Yeah, absolutely. I think that's a great question. And as far as, handling cash in the market, typically the best way to approach just having a new pool of cash to put to work is to dollar cost average it. If you have any substantial amount of money, and I'll leave that to you and your clients to try to determine exactly where that line may lie. But with a substantial amount of money, it typically makes sense to spread out your investments over time. So maybe we would put half of the cash into the market immediately, and then maybe 25% in a month and another 25% in another month. That's one way you can handle volatility, because if the market is down, which it is, you obviously want to be taking advantage of lower prices, but you also have to be wary of the fact that the market that has gone down can continue going down. So it's typically a good risk mitigation approach to try to dollar cost average, so that regardless of what happens in the future, at least you have part of your money invested. If it turns out that the market keeps going higher, at least you have some money that's gotten those lower prices. And in the event that the market does go lower, you'll continue to take advantage of lower prices. So that's one strategy that works well over time for new money. As far as taking money out of portfolios, people who are in that distribution phase, the entire reason we have the portfolio broken up into stocks and bonds is because stocks are much more volatile than bonds. The type of price movements you're going to see with stocks, both higher and lower, are typically quite a bit more than what you'll see with bonds. And even looking at the first half of the year, you can see that the S&P 500 was down about 20%. The bond index was down about 10%. Now, being down 10% obviously is not great, but it's approximately half as much as the stock market. So to the extent that you're taking money out of your portfolio, typically you'd have more money in bonds than you would otherwise when you're in the capital appreciation phase. So by having more money in bonds, you're giving up some of the upside in terms of how high a return your portfolio potentially could return. And that's why when you're accumulating, when you're in the accumulation phase, you want to have more of your portfolio in stocks than in bonds. The reverse is also true. The other part of it is the bond portfolio is just not a single monolithic piece. There's lots of different parts of the bond portfolio. Some of the bond portfolio has longer duration bonds, longer term bonds. Some of them has shorter term bonds. Some of the portfolio has some credit risk. Some of the portfolio has some interest rate risk. And the idea is that there should be some part of that bond portfolio, even if on average bonds are down 10%, and let's say some of the bond portfolios that we're running are down even less than the index, which I believe is the case, there's parts of the portfolio that have not moved as much. And so a good strategy for taking money out of the account, and that's one that we'll employ together on behalf of the clients, is to try to take a little bit more away from those more stable parts of the portfolio, less go into the stock portion of the portfolio in order to take out earnings, because all things being equal, if you can stay invested in stocks while they're down, let that entire piece recover and eventually start gaining again, that's better than potentially selling low. But ultimately, over time, there's no way to know which years will be up years, which years will be down years. That's why it's important to have a diversified portfolio, and that's why it's important to be smart in terms of how you take out those distributions. But ultimately, as long as your asset allocation, your mix of stocks and bonds, and the types of stocks and the types of bonds you have in your portfolio are appropriate for the phase of either accumulation or distribution, all of those approaches can be very helpful and help to mitigate a situation as this, where both stocks and bonds are down together, which is relatively rare. It happens over the course of your lifetime, but it doesn't necessarily happen year by year or even decade by decade.
Okay, very good. Well, obviously you can't give recommendations on individual securities because everybody's situation is different. But if you look across the sectors of the stock market and even look into fixed income and the bond market, where do you see some bright spots?
So exactly to your point, speaking more generally and looking at areas where we think there's more value as opposed to less value, just empirically across the board, not necessarily for any one particular person's circumstances, we still think there's opportunities both within some of the defensive sectors like healthcare and like consumer staples, and we're a little bit concerned about some of the more cyclical sectors like industrials and financials. To the extent that the Fed is raising interest rates, all things being equal, that's typically good for banks. But the reason the Fed is raising interest rates is because of inflation, and the fact that the Fed is forced to raise interest rates so quickly, I think, can lead to a more challenging economic condition. And ultimately, despite the fact that banks typically do well in a higher inflation environment, they also do worse in a worse economic environment. So I don't know that the economy has necessarily weakened to the point where a recession is imminent, but clearly there's an elevated risk of recession down the road, whether that's next year or the year after, because the Fed is raising interest rates so quickly. So I think that's a reason to use a little bit of caution with the more cyclical sectors, and it's a reason to potentially look to some of the more defensive sectors at this point in time as being relatively more attractive.
You're probably familiar with Jeremy Siegel, who's the professor at Wharton that's on CNBC pretty frequently, and I heard him make the statement that it's been critical for the Federal Reserve to pump the brakes a little bit but not send its passengers through the front windshield. And that's, I think, a little bit what we all feel like right now. But talk about fixed income. If you're evaluating that component of somebody's investment portfolio, where are you putting the money?
So within fixed income, we still are continuing to favor slightly more safer. So safer in terms of shorter duration versus longer duration, looking to have a little bit less interest rate risk. And likewise on the credit side, looking for a little bit higher credit quality versus less credit quality. You know, we would argue that when you're in a recession, when the economy is in a bad place, that's the time to go back in, take a little bit more interest rate risk, take a little bit more credit risk, because most likely the increased risk to those two parts of your portfolio have already been reflected in the price. So assuming that prices have already reflected some of those recessionary or more challenging economic environments, that's typically on average a better time to buy those types of assets. And the reverse is also true. Before people completely capitulate and are willing to acknowledge that a recession is imminently coming, typically those more risky, so either credit risk in terms of maybe higher yielding bonds or companies with lower credit ratings, which typically go together, or for those types of investments where you're looking much longer duration in terms of a bond that maybe matures 30 years from now as opposed to 5 or 10 years from now, that has more interest rate risk. All things being equal, we feel it makes sense to be a little bit more safe in both directions and not necessarily take on more risk. That will change, if and when pricing changes to reflect economic conditions on the ground. Because again, it doesn't appear that we're in recession at this point in time. And despite the fact that the markets have been very volatile, the economy at least seems to be holding up relatively well.
Very good. Well, I know you're probably wishing you were back on the Riviera in France right now, but we appreciate you taking time out to speak with us, and thank you for everything you're doing up in North Carolina.
Stan, it's always great talking with you, and although you can't stay on vacation forever, it is nice to take a vacation every once in a while, and then you get back to real life. And wouldn't trade it for the world. This is a great job. It's a challenging job, but I really enjoy it, and it's great working with you and your clients.
Great. Thanks, Chris. Okay, so we're honored today to be able to spotlight somebody that's a good friend who's affiliated with an organization known as Hang Tough. Traylor McNeil is here with us, and Traylor, welcome. And she is the Director of Development for Hang Tough. Tell us a little bit about what Hang Tough's mission is.
First, thank you for having me on, Stan. Hang Tough Foundation, our mission is building community and engaging families through support and meaningful experiences during their journey with childhood illness and special needs. The vision for Hang Tough is to encourage strong and resilient families to invest in one another and build a greater inclusive community. So Hang Tough was founded by two local moms, Michelle Hart and Janelle Irwin. Both had children with pediatric cancer diagnoses, specifically leukemia. Thankfully, both are in remission today. The foundation is 7 years old. It was founded in 2015. The two moms just saw a need in our community to rally around families going through any type of chronic life-altering illness or special needs. So Hang Tough does not take care of the medical or therapy needs of each child. We just seek to make sure that each member of the family is well supported emotionally and mentally throughout the process of their journey. And we offer 10 programs, all at no cost to the families. These are geared at different pockets of the family unit. So they include Parents Night Out, support groups, tutoring services, family fun events, Santa Day, care packages, school supply drive, and sibling support, and many more.
So number one, how do you find out about those in need, or how do they find out about you? And I'm guessing that once they're engaged in the program, there's kind of an ongoing rapport with the agency that sort of monitors the progress and that type of thing. But talk about, one, how they find out about you, or how you find out about them, and two, how you interact once they're in the loop, so to speak.
So first, when we find out children in the community, we're serving ages 0 up to 21.
Okay.
So when we find out about a child or young adult with a diagnosis of any type, it's not just cancer, it's any life-altering illness, we immediately make a reach, whether it's through email or social media, respecting the privacy, certainly. There have also been instances where a grandparent will reach out to us on behalf of the family. Then we make the reach. And then it's just at the discretion, for lack of better wording, of the family to jump on board, with Hang Tough. At the moment, we are serving over 900.
Oh, wow.
Heroes and their families, again, just focusing on the family as a unit. So it has grown exponentially, nurturing the relationships. Once they are a part of Hang Tough, that continuation is more through our social media channels. They are connected through email, they're connected through social media, and they can find out about the different events. They get invitations.
Is there anything you want to highlight that's just around the corner coming up?
Absolutely. Our Go Gold campaign, which kicks off September 1st and runs throughout the month of September. And that is bringing awareness to pediatric cancer. And Hang Tough is one of 3 beneficiaries. Caitlin Irwin will be the one kicking the event off, and it will run all month. There will be information on our website as well as the gogold.com website. And second would be our inaugural sporting clay tournament, which is Friday, October 21st from 10 to 4 at Talon Gun Range.
Traylor, we really appreciate you taking time out to come in for a few minutes. And I know you've got an extremely busy summer with all you've got going on, but we really respect what you're doing with Hang Tough, and just thank you.
Thank you so much for having me, and please reach out if I can ever be of assistance. Thank you guys so much.
Chris Zaccarelli of Independent Advisor Alliance are independent entities and not related or endorsed by Barnes Capital Group or LPL Financial. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risk, including the potential loss of principal. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful. Dollar cost averaging involves continuous investment into securities regardless of fluctuation in price levels of such securities. An investor should consider their ability to consider purchasing through fluctuating price levels. Such a plan does not ensure profit and does not protect against loss in declining markets. Asset allocation does not ensure a profit or protect against loss. This material contains only general descriptions regarding insurance needs and products. This content is not a solicitation to buy, sell, or replace any existing policy. Please speak to a financial professional regarding your specific insurance needs prior to taking any action. All performance reference is historical and no guarantee of future result. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individuals. To determine which investments may be appropriate for you, consult your attorney, consultant, financial advisor, or tax advisor prior to investing. Securities offered through LPL Financial, member FINRA SIPC. Investment advice offered through Independent Advisor Alliance, a registered investment advisor. IAA and Barnes Capital Group are separate entities from LPL Financial.